Hi there, welcome to Grain TV. I'm Kevin McNew. It's Wednesday, November 30th, a down day in the grains. Let's take a look at Grain Edge's trading platform and see where we closed. In Chicago, beans continuing to lead to the downside, losing 10 cents a bushel. Corn in Chicago managing only a half a cent loss, while Chicago wheat was off 6. News today was really focused on the crude oil market and the announcement by OPEC that they reached an output cut deal. We'll get to that in a minute, but first let's talk about some of the ag news that was out today. First of all, let's take a look at Russia. Russia's Soviet Econ private consulting firm, the first sort of guesstimate of what their crop will look like this coming year suggests it's going to be very large, coming in at 112 million metric tons. Still a little bit lower from last year's record of 119.5, but a very sizable number. Still very early in the growing season. Obviously, they're in winter dormancy for their wheat crop there. A lot of game left in terms of growing conditions, but more signs that there's going to be plenty of wheat in 2017. On the other side of the spectrum, we have China announcing that they are having problems with land quality as a result of ramped up production over the last 10 to 15 years. And so they're actually making moves to limit ag farmland and preserve and basically try and rehab that polluted or less productive land. So they are suggesting that they will see a 15 million metric ton decline in production over the next 5 or 6 years as a result of this government policy to limit this overproduced land. So that is more of a long-term factor, obviously. Other news out today, speaking of China, they were in the market for beans, buying two cargoes of U.S. beans, 123,000 metric tons. But overall, it was really a day to talk about crude oil, and the announcement today by OPEC that they had reached a deal not only within the OPEC countries themselves, but also getting Russia on board and some other non-OPEC countries to agree to a production cut. All totaled, at least as of now, it looks to be about a 1.3 million barrel per day drop in production, and that has certainly got the crude oil market shooting sharply higher, touching a $4 a barrel increase at one point during the trade session. Overall, it was certainly a crude-focused day. Grains were not able to carry any sort of momentum along with crude oil. Speaking of crude oil, let's talk about EIA's ethanol production numbers. Those numbers came in a little bit light on production with 2,000 barrel a day drop, still over 1 million barrels per day, which is a good number for this time of year. And stocks were off 500,000 barrels per day. On the crude oil side, EIA's inventory numbers were also light. Traders had been looking for crude oil inventories to build in the past week, but instead they fell 800,000 barrels. So that was certainly supportive in conjunction with the OPEC announcement. Tomorrow we'll be looking at export sales. Those are coming out at 7:30 Central Time. Expectations range from 300 to 500 for wheat, 900 to 1.2 million for corn, and on the low side, expectations are running only 1 to 1.4 million for beans because of the holiday shortened week. Speaking of crude oil, let's talk about some of the trading strategies you can utilize when you are trading with Grain Hedge. And one of the things, of course, we've been talking about is our technical alerts platform that helps guide you in technical decisions to make a trade. And after looking at the crude oil announcement this morning, we came in, the overnight session was very strong in crude oil, up around $3 a barrel, but when we looked at it this morning, it was still showing more upside potential in crude oil with the January contract, at least a long-term target on our technical alerts platform, looking for 51.28. Now, as a trader, there's a lot of risk in a market like this, so I don't want anyone to think that this is a market to jump into. But the nice thing about a Grain Hedge trading platform is that we have what's called a trailing stop. And a trailing stop is a nice feature because when you place a trade, you can set a stop that trails the market and moves up in conjunction. So in this case, we happen to be trading the crude oil market today getting in at 48.60 after the EIA announcement. We put a trailing stop right around that 48.60 mark when the market was 49.20. Now, the nice thing is when the market moves higher, that trailing stop will automatically move up in conjunction with you. So you'll see the market, in the case of crude oil, was very volatile, has very sudden spikes here. And as that market spiked higher, the trailing stop moved up from 49.20, from 48.60 up to 48.90 as a result of the market moving higher. So the nice thing about a trailing stop, it gives you some price protection. It gives you some protection against the market moving against you. And as the market moves in your favor, then it can move up in conjunction as well. It's a nice feature because you're not having to follow the market tick by tick and adjust that stop and bring emotions into it. That's a very powerful feature for those of you in trying to manage your hedge positions. As always, if you're interested in learning more about our grain hedge trading platform or the other services we offer, including technical alerts, daily cash bids from over 4,500 different markets, all for only $7 a trade, visit us online at grainhedge.com and sign up for a free demo of all of what we have to offer. Have a great day. We'll talk to you tomorrow about export sales.